Hi, I'm Debi Peverill, and you're listening to the weekly tip from Painless Financial Training Group. I'm talking about passive income in an active business today and the changes that the federal government has recently announced to set a threshold for that. So, as you probably know if you've been following this space, the business community in Canada has been obsessed with the July 2017 changes that were proposed by the federal government. And I've talked about lots of them, but today's the passive investment one. So, a business that's incorporated, that has active income, pays tax at about 14% a year. So if you have $10,000 in profits, you're going to have $1,400 you send to the government for tax, and you've got $8,600 left over, likely to pay the shareholders, but possibly to invest. Because you've only paid 14% tax, you have more money to invest than an employee would have who pays tax at a higher rate, and this troubles the government. The issue then is, how are they going to tax at a higher rate income that is left and reinvested in the business? And they haven't made the rules yet. They're going to be announced in the 2018 budget, apparently. But what they have done finally is set a threshold. And the threshold is $50,000 of income earned from investments retained in an active business. So $50,000 of income likely translates to about $1 million in investment. So I'm thinking for most small businesses, this is no longer an issue. There's not a lot of chance you have accumulated $1 million inside your active business in order to invest. And the reason you probably haven't done that has to do with the capital gain exemption, but that's another issue. So take a look at what you're doing. If you're accumulating amounts of investment inside an active business, you probably should be talking to your tax preparer anyway, because you don't want to be offside of the exemption. But this rule, where there was going to somehow be a super tax on any investment income earned in an active business over and above the tax you're already paying, and recognize that dividends, interest, and capital gains are already being taxed probably 30% higher than the active business because it isn't active and you don't get the small business deduction. So, thing to remember, unless you're accumulating a lot of money in your corporation that you accumulated at active tax rates, you probably don't have to worry about this because of the $50,000 cap.